Welcome to the deep dive. Today we're looking into something a listener asked about, a specific way to maybe build some long-term financial stability.
That's right. We're diving into the GBU Asset Guard Fixed Index Annuity.
Yeah, exactly. The goal here is, well, to cut through some of the jargon and really understand how it works, especially for someone who wants to learn quickly.
Precisely. Trying to figure out that balance, between potential growth and keeping your money safe. Let's break it down.
Okay, let's start with the big one. Principal protection. That sounds, well, pretty appealing. Zero exposure to market losses.
That's really the core promise here. With a fixed index annuity like this one, your actual money, your principal, isn't directly in the stock market.
Okay.
So even if the indexes, it's linked to like the Barclays ones or the US Tech or the Fortune 500 index mentioned, even if they go down.
Your initial amount is safe.
Exactly. Your initial deposit is protected from those market declines. It's like a base loan guarantee.
Okay, safety net established.
Yep.
But how does it grow then if it's not in the market? It's linked, you said.
Right, market linked. It earns interest based on how those chosen indexes perform. Could be over 1 year, could be over 2 years, depending on the term you pick. But the key is you only get credited interest if the index performance is positive. If the index drops, you just don't earn interest for that period, but you don't lose your principal either.
I see. And it looks like there's some choice in how you set this up, like 7 different crediting strategies, including a simple fixed interest option.
Yeah, that flexibility is important. It lets you kind of hedge your bets, maybe.
How so?
Well, you could put some money in the fixed account for a guaranteed, predictable, though likely lower return,
Okay.
and then allocate another part to strategies linked to those indices, hoping to maybe capture higher returns if the markets do well. It's about mixing and matching to what feels right for you.
Gotcha. Now, about those index-linked parts, the participation rates, how much of the index gain you actually get credited? They're guaranteed for 4 years.
Yes, that 4-year guarantee provides some stability on that front. You know what rate you'll be working with for that period.
And there are these booster fees to potentially earn more? What's the deal there?
Right, the boosters. It's basically an option where you pay an extra fee, like 1% or 3%, hoping it'll increase your participation rate or potential return.
A trade-off then.
Definitely. You'd need to weigh if the potential extra earnings are likely to outweigh that fee based on how you think the index might perform. It's an added layer of complexity to consider.
Makes sense.
Yeah.
Let's talk liquidity. Getting access to your money, I see 10% annual penalty-free withdrawals.
Correct. Most years you can take out up to 10% of the value without surrender charges kicking in.
And something about 20% cumulative.
Yeah, if you don't take the full 10% 1 year, you might be able to carry some of that allowance over up to a 20% limit in total for certain situations. It adds a bit more flexibility.
But the big one seems to be this 100% liquidity window every 4 years.
That's a key feature. Every 4 years, there's a specific period where you can access the entire account value without any surrender charges. It's a defined exit point if your plans change.
Okay, that's pretty clear. And the tax angle, tax deferral.
Ah, yes. Classic annuity benefit. Any interest you earn grows tax-deferred. Meaning you don't pay income tax on the gains each year. It only becomes taxable when you actually withdraw the money, presumably later on, maybe in retirement.
So it can compound more effectively over time.
Potentially, yes. That's the idea behind tax deferral.
And there's also mention of guaranteed lifetime income options for retirement planning.
Exactly. You can usually choose to turn the annuity's value into a stream of payments you can't outlive, either for just yourself or maybe covering both you and a spouse. It's about creating predictability in retirement income.
Right. We should probably touch on the surrender charges again, those 7 to 8% fees.
Yeah.
If you pull money outside those liquidity windows, they repeat.
Yes. The surrender charge schedule typically resets after each 4-year liquidity window if you stay in. It's designed to encourage keeping the money invested long term, but those defined liquidity points are your way around them. You just need to be aware of the schedule.
Understood. And just quickly, eligibility seems broad, ages 0 to 95, and a $25,000 minimum.
That's quite a wide range, yes. And it accepts both qualified, like IRA money, and non-qualified funds.
So thinking back to our listener who wants to get up to speed, this GBU Asset Guard seems to offer, well, a package deal. You get that downside protection.
The principal safety.
Paired with the chance to grow based on market indexes, but without direct market risk, plus choices in how it grows and specific ways to access the money.
It really tries to hit that middle ground: security, potential growth, some flexibility, and the tax deferral piece. Key things people often look for in long-term planning.
So the final thought for you, our listener, is this. Considering your own long-term financial picture, how might a product that tries to balance market-linked growth potential with that guaranteed principal protection fit into your overall strategy? Something to think about.